Fed did pretty much exactly what was telegraphed. They raised 75 basis points. They did what was expected. So what was the big kerfuffle? And the kerfuffle actually cuts both ways. When the press release from the FOMC first came out, the markets took off. They went, major green, across the board. The major indices, gold was up, because there was the appearance of opening the door to the step down, to the slowing, the eventual slowing of the rates that everybody knew had to come sooner or later. And then, as so often happens, the moment Powell opened his mouth, the markets tanked. They went up and down. I posted a chart, and this isn't just some meme out there. I actually wrote down timestamps for when Powell said different things, watching the market go up and down. And I annotated the market turns and what Powell said that made the markets turn, which it did several times. It ended up down. So here's my take. A lot of journalists and a lot of talking heads on Bloomberg, maybe even Kitco, other places, were asking, how is Powell going to thread this needle? On the one hand, everybody knows that the Fed can't be raising rates 75 basis points forever, but they don't want the markets to get giddy and take off, so they have to balance that in some way with some kind of negativity. And how are they going to manage this? So the answer was to put the good news in the press release and then have Powell come and play bad cop and beat up on it, beat the market with his jawbone until it went back into the red, which is exactly what happened by the time he was done with it. So, the key things that he said on this and how he jaw beat the markets down was it basically admitted that, yes, that there would be a point where they would have to slow down the increases. Oh boy, the market took off again. But then he said that rate of increase is really not what's important. It's the terminal rate and how long they maintain rates higher that are more important, and that terminal rate is likely to be higher than previously anticipated. So that was more bad news. That was not already priced in. And I think that's why markets reacted negatively. So I think the important takeaways for investors are that despite the easing talk that the Fed put in there to give itself room to pivot if it has to, Powell very clearly answered the question more than once. What are you going to do if push comes to shove? Is it going to be the economy or inflation? We are going to err on the side of doing too much or too little. And he very clearly said doing too much. And the reason why he quickly reassured the audience that, but don't worry, we have the tools to step in and support the economy if we go too far. In other words, they're planning to go too far. They will go too far. That's the default program right now. But don't worry, we have the tools, we'll fix it. Of course, this doesn't reassure me very much, David, because before when they were saying, don't worry about inflation, there's no inflation, or then, it's just transitory, but don't worry, we've got the tools, we can fix it. Well, guess what? That toolbox hasn't done a great job so far. And it worries me to hear him talk about pushing the economy too far because they've got the tools. Takeaway, David, is, and I hate making big, bold predictions, but here it is. You've got me to make a big, bold prediction on Kitco News. Clearly, the market is not that efficient. And more to the point, I think, for resource investors, and particularly metals and mining investors, analysts like me, is there's so much information out there that is just ignored or not available to the broader market. The market is very inefficient when it comes to niche markets. I would say that the more niche, the more focused your investment is, the less applicable the efficient market hypothesis is. Markets are irrational. As the saying goes, they can remain irrational longer you can remain solvent. But this matters to us as a speculator. Because they're irrational, because they're emotional, they overshoot. And our audience, I'm sure they have seen a gazillion times, markets overshoot. They get overbought, they get oversold. And because that happens, because price and value diverge inefficiently, there's opportunity for speculators to pick up value that's underpriced or go short on overpriced, misvalued. But the good news is that people who understand this and who know how to play it in their favor can use this market inefficiency to make money. The interest rates have to be higher than CPI to bring it down. Other people harp on this all the time. And Powell acknowledged that that's how things were in the past, but maybe he clearly doesn't think that you need to do that anymore. CPI at above 8% means that interest rates should be 9% or higher. But that's not what the Fed is looking at. And Powell said this specifically, they're looking at the PCE. which came in high at 5.1. But the difference between trying to get an inflation rate of 5 down to 2 is massively different from trying to get an inflation rate of 8 down to 2. So rather than predict an end inflation rate for you or an interest rate for you, Powell himself has said that the rate of change isn't really what's important. It's the terminal rate and how long they keep it there to meet their goal. I don't think inflation is going to come down as easily as they say it will. And I think that there will be a lot more pain. I think higher interest rates will affect earnings, will affect revenue, will cause mass layoffs. And I think we'll see that in 2023. And I think that will cause a change in policy. I think we may see bear market rallies, but they will be rallies on a downward trend that I think will endure for years. You could see a great deal more inflation with this recession, a stagflationary recession. You could see prices of commodities and assets go up. So you could actually see the Dow and the S&P 500 hit new nominal all-time highs in the midst of devastation. As we've been through a phase here, commodities go in cycles, these stocks go in cycles. And we've been through a phase where commodities prices, metals prices in particular, took off well ahead of input costs. And the companies were able to do better. The responsible ones, the better ones, cleaned up their balance sheets. And, things got better. And people were able to report earnings, distribute more dividends to shareholders, or help shareholders via buybacks. All kinds of good things happened actually over the last couple of years, despite the pandemic. But now we're at a place where input costs are starting to catch up. The inflation that we see worldwide isn't just showing up in the 8.2% or 9.1% or 10.7% if you're in Europe in mining costs. It's not like that. You look at the statements that you're coming out of producers and even the people building their mines, and suddenly, the COVID restrictions and the higher costs on steel and some plant that would have cost $100 million now costs $200 million. Or your reagents for your plant to the cyanide and the other stuff you put in the tanks to get the gold out. It used to be, let's say, 5% of your margin. I'm just making the number up. And now it's 10% of your margin. These are massive cost increases. So what I'm saying is that this is a time to be extremely careful, and particularly to the Buffett admonition or the efficient market hypothesis. I think this is not the time to invest in ETFs in the mining sector. It's a terrible idea. Or just going with the average or whatever. I think you need to be very selective. I think you need to be a stock picker. And sorry, I've got some bit more bad news here. I do think, as I was saying before in our conversation, the Fed will break something. Mm-hmm. I think we're absolutely headed for recession. I think the global recession is already shaping up. We see it in the UK. It's writing clearly on the wall in Europe. And I think the US is headed that way too. That is bad for commodities. It's always been bad for commodities. Metals prices take it on the chin. And we could argue about how fiscal policy is going to boost metal prices, or the Green New Deal and all the batteries are going to boost metal prices. You can make lots of arguments, and maybe they're right over time. But the immediate response to recession is lower metals prices. And I think that's what we see ahead. So as much as I love commodities and I'm a metals and mining guy, right now for metals writ large, industrial metals, I'm not buying anything right now, David. My shopping list is completely blank from that. The only thing I would buy right now, like right now, is a great uranium stock that I might have overlooked before, because I think that is very separate. And we can talk about that or not as you like, but just putting that out there. As for gold and silver, they're not just commodities. They're also monetary metals. So I'm more optimistic about gold and silver, but they have had a bad year so far, and that has the stocks on sale as well, which means that they're subject to tax loss season. Now, since these aren't just industrial metals, I actually see that as a nearer term opportunity. Like today, David, if after we get off this call, I was informed that I overlooked some fantastic uranium stock and it was on sale, I would be willing to buy that right now. Gold and silver, I'd probably wait till next month to peak tax loss season in December. and see, what the cat drags in. It could be that there are some terrific companies being selective again, not buying the average, not buying the ETF, but looking at the guys that did clean up their balance sheets or that did secure fixed costs for their mine building project, or that they're an explorer and they secure 2 or 3 years worth of funding and they can work through whatever downturn in the near term. Stocks like that go on sale during tax loss season in gold and silver would interest me in December. But copper and industrial metals, other commodities, not until we see the shape of the recession, probably not until next year. Oil would be the one sort of between uranium and other commodities, and it would depend on how things shape up. But even oil, I'm not looking to buy oil right now, even though I think triple-digit oil prices will be the new normal. The recession, can't overstress this. I know there are optimists out there, and I know we want to believe in our mining stocks, but recessions are always bad initially for commodities writ large.